We're going to bring in Bill Nelson. He's a former top staffer at the Fed. He basically did Fed window discount policy for many years. Now he's executive vice president, chief economist of the Bank Policy Institute. Bill, thanks for joining us. And the proviso, folks, is that Bill cannot talk specifically about Silicon Valley Bank, which is the cause du jour, so to speak. But in any event, Bill, thanks for joining us. I wonder if we could talk about the general issue here, which seems to be of concern to bank investors and investors broadly. They had a bank has a whole bunch of assets or got a whole bunch of deposits, went and bought some bonds. Those bonds declined in value, and a bank has a run on those deposits, and all of a sudden the assets or the liabilities against those, the assets against those liabilities have declined in value. How pervasive is this in the banking system right now, do you think?
Well, with the significant rise in interest rates that's occurred, banks have, of course, like everyone else, made losses on their longer-term securities, treasuries, MBS. But those losses, but at the same time, banks are currently incredibly well capitalized. They have passed rigorous stress tests there, and so as a general matter, I would say it's not an issue to be worried about for banks generally, but it is true, certainly, that lots of banking institutions have longer-term securities on which they've made substantial losses.
We were talking in the last hour, Bill, about the ability of a bank to go to the Fed's emergency lending discount window and then say, you know what, I got all this paper. I don't want to sell it, or I can't sell it, whatever the reason. I want you to give me immediate overnight funding for it. Can a bank do that these days?
Yeah, of course. That's the purpose of the discount window, and not just emergency funding. A lot of funding is mundane, but any bank can bring collateral to the discount window and borrow against it if they're financially sound, if they're adequately capitalized. They get credit under one program. If they need trouble, if they're under more distress, then the situation is a bit more managed by the Fed. The Fed values those securities at market, applies a conservative haircut to them to determine the lendable value, and then lends against those.
So even a treasury, and especially as Andrew was saying earlier, they have a lot of, this particular bank we're talking about has a lot of mortgages. A mortgage-backed security, if it was sold at par at 100 and now it's at 90, you would get 90 minus some other haircut that would protect the Fed, and so you wouldn't get the 100 at par value at the discount window. And that's one reason why banks are reluctant. Plus, there's a stigma attached to it. So they went out and tried to raise equity. Bill, how do you think what's happening now or concerns about the financial system will affect the Fed when it comes to interest rate hikes?
I think that the Fed has, well, that's an interesting question. I don't think it will. I don't think that this is going to be a significant financial system problem, and so I don't really think it's going to have much of a impact on the Fed's decisions about interest rate hikes. They're making the decisions based on their objective of bringing inflation down to 2% and maximum employment, down the road as well. So I don't think that this is going to rise to the level of interrupting that.